Matt, let's get right into the reports, though. So John Chang from Marcus Millichap put a really, I think, pretty good video. Pretty straightforward, just looking at inflation risk exposure and comparing different commercial real estate asset classes, multifamily, self-storage, but also office, retail, hospitality, and just ranking, the risk due to inflation. And, we've been talking about this a lot, Matt, but it's no major surprise that, multifamily is one of really the best inflation hedges out there, especially in commercial real estate. The only two that they said, could beat out multifamily slightly are self-storage, because you're often resetting rents monthly, but then hospitality, where you are resetting your rates on a daily basis, so you're really able to track inflation.
Yeah, it is. So it is interesting that, I guess not quite so interesting that all of CRE really is a decent hedge against inflation. And that's what it kind of prefaces everything, is like, it's historically been a decent hedge against inflation. It can really kind of float above it. But yeah, multifamily, and it is determined, it seems like, by how quickly can you get a new rent at a new price that tracks inflation, rather than kind of being a victim and being a victim of circumstance and kind of trying to make up for past, maybe you've got a 5-year office lease and you're going in 2018 dollars and now it's 2022 and you're really struggling.
And they mentioned that on the video, saying that, some office leases have inflation provisions, that will bump up, but many don't. A lot of your higher credit tenants, they're not going to allow those provisions. So there's definitely a higher risk for some of those longer term leases for certain. And again, I think it's what is providing the opportunity, because you have the ability to track inflation, as at the rate you're renewing leases. But not every owner is on top of it.
That's true.
And that's what creates the inefficiencies. It's not like it's all being done automatically. And so what we're looking for are assets that, just the manager last year, they were just asleep at the wheel and kept rents the same, which we're seeing very much across the board, especially on lease renewals, where you're still seeing, anywhere from between kind of a 3 to 5% rental increase, when rents have increased maybe 15% in that market. So let's say you go through a year or two of that, of 10%, total increase over 2 years, where the market's increased, 25 or 30%, so you've got a huge gap. And once that unit eventually becomes online, that's a major rent increase at that new rate, and that's where the entire market is. And so finding those opportunities where, again, management is just asleep at the wheel, and sometimes even better, is, they've just started moving these leases. Maybe they're not doing a lot on renewals, but the new market rents are significantly higher, and they've really proven out the thesis because they've achieved it. And so you can get 100. This is just an example of kind of what we're seeing. Okay, so we know it's $150 more, their new market rents compared to their average lease rents. Pretty confident that on the older average leases we can get them up.
And that's a really good insight into how you actually can take action and how you can really find opportunity in this situation. People talk about CRE as a hedge against inflation, as this kind of refuge against inflationary pressures. But if you're actually looking for opportunities here, you can really find a place that hasn't moved along with inflation, and you can use your own expertise and your own knowledge to bring that value up and make more profit. So I thought that was interesting.
And it depends on where you are in your place in the investment, or the capital stack, and what your role is, whether you're a passive investor or an active investor. But I do think that active investors or passive investors partnering with active investors, there is a major advantage when we see these types of opportunities. But then also what you were saying is, by adding some value, really pushes the needle and can really accelerate it. So all of a sudden, not only are you getting that 100, there's 150 organic, but if you can get another 150 to 200 because of the renovation, you're bringing into a whole other class of asset. That's huge. And expenses are rising as well. There was a Jonathan Barr made a post on LinkedIn about saying that, and I think it was a really good point. And we'll tag him in this video, but so many people are talking about rent growth, but no one's talking about expense growth. and
like utilities,
everything. So, I mean, for example, payroll is going up, and it's going to continue to go up. I mean, without a doubt, to retain the right talent. And there's nothing more important than like who's actually on site managing the properties.
Well, and one of the things that I thought maybe was shaping some of the decisions that you're making in terms of the strategies that you're going after is those increased those increased prices, are those making you think twice about value add and maybe doing something a little bit more moderate than major?
Sometimes, absolutely. And it's more the uncertainty of like, can we get the materials? Can we get the appliances? That being said, it can be difficult, but you can usually get the stuff. Yeah. And maybe you're going to pay a little bit more for it. However, what we're finding is the amount that rents are increasing completely offset the expense growth. That being said, you still need to use the proper expense inflation assumptions, and if you are using the same kind of dollar per unit assumptions in your underwriting model that you were using in 2019 or even 2020, are using the wrong assumptions. Because if you were assuming that payroll is going to be $1,000 per unit or $1,200 per unit, which was somewhat typical, it's not going to be $1,000 per unit anymore. Just the salaries for community managers, leasing associates, not to mention maintenance staff. I mean, all this infrastructure work that's going on. I mean, it's hard to find good maintenance supervisors, maintenance techs, especially since it's a very randomly skilled jack of all trades type position. But you said first, utilities. I mean, across the board, we saw huge utility increases at the beginning of last year. I think on most of our properties it was a missed a budget. Looking at our budget variances, just because we just had a surprise. All right, utilities are going up. Now again, you can offset that. At the same time, we were implementing utility bill back programs, but sometimes, that's so you can only pass on some to residents. But rents are outpacing, but it's something to watch for, because if you're using a standard 2% inflation assumption, which was kind of the standard assumption for many years, and average, it probably will be, over the long-term average, 3% organic rent growth and 2%, average expense inflation. How convenient, obviously, income's growing faster than expenses, which typically is. But if you're using 2% general expense inflation for 2022 and 2023, you better hope that your rent growth is overly conservative and you get more rent growth than you anticipated. Yeah. And you beat income, but you're going to miss on your expense budget. Yeah.
So basically, pay attention.
Pay attention.
Because maybe there are places where expenses haven't risen, and you can pursue that individual project. But if you're sitting on your hands, not raising rents, or moving forward with a planned value add that doesn't account for increased prices, then maybe you need to shift your plans.
Yeah. Bottom line, if you are assuming high organic rent growth due to inflation. If you got 10% organic rent growth plugged into your model for a year and you have 2% expense inflation, that doesn't make sense.
Okay.
So if you're moderate on the organic rent growth, sure. But if you're saying, there's going to be so much inflation, but my expenses aren't going to see inflation, that's just, again,
you gotta
your
look
rent
at
growth you may be saved just because of how strong the market is. Yeah. And I think that'll probably be the case with most, but it's something to be, I would say, hyper aware of.
Yeah.